This video introduces the basic accounting equation and then links the 4 financial statements to it. The mechanical process linking business transactions to the preparation of the financial statements is based upon a fundamental algebraic equation, which we have already seen in prior videos, called the basic accounting equation. It states that assets, the resources at management's disposal, are always equal to liabilities, the obligations of the company, plus shareholders' equity, the investment in the company made by the shareholders. The phrase shareholders' equity is used when referring to the equity of a corporation because the owners are called shareholders. The phrase owner's equity is used otherwise. Simply, assets represent what the company's managers have to work with, and liabilities and shareholders' equity represent where the assets came from, the sources of the assets. Liabilities are obligations to be paid back in the future, and shareholders' equity, the investment made by the shareholders or owners. Assets, liabilities, and shareholders' equity are each comprised of a group of accounts into which the transactions entered into by a company are recorded and balances are maintained. Assets, which represent resources designed to generate revenues and eventually cash, are divided into 2 account categories: current assets and non-current assets. Current assets are expected to be converted into cash sooner than non-current assets. Current assets include the company's cash balance, short-term investments, investments expected to be converted into cash relatively soon, accounts receivable, dollar amounts expected from customers for whom services have been rendered but who have not yet paid, inventory, the cost of merchandise or products awaiting sale, and prepaid expenses, expenses that have been paid for prior to their use. An example is insurance, which is paid for in advance of the coverage period. Non-current assets include long-term investments, investments expected to be held well into the future, the cost of property, plant, and equipment used in the business, and the cost of intangible assets, such as patents and trademarks, that help to generate future revenues through the use of exclusive rights. In prior videos, we have referred to the non-current assets and the short-term investments as producing assets, assets that support operations. Think of them also as investments, the related cash flows of which are reflected in the investing section of the statement of cash flows. The current assets, except for the short-term investments, have been referred to in past videos as operating assets, and their related cash flows are reported in the operating section of the statement of cash flows. Similar to asset accounts, the liability accounts are divided into 2 categories, current and non-current. Current liabilities are expected to use cash in the near future, while non-current or long-term liabilities are expected to require cash payments farther into the future. Current liabilities include a variety of accounts. Examples include accounts payable, dollar amounts owed to vendors or suppliers who have delivered inventories and not yet been paid. Accrued payables represent obligations that result from expenses that have been incurred but remain unpaid. Unearned revenue reflects transactions where the company has been paid but has not yet performed a service or delivered a good. It represents the fact that the company still owes the service or the delivery. Short-term notes payable are normally the principal amount related to bank loans from borrowings expected to be paid relatively soon. Non-current liabilities include long-term notes payable, the principal on bank loans from borrowings expected to be paid off in the relatively distant future, and bond payable, which represent obligations related to borrowings created when bonds are issued to a variety of lenders called bondholders. Shareholders' equity, a measure of the investment made by the shareholders, includes 2 account categories: contributed capital, and retained earnings. Contributed capital is a measure of the funds invested by the shareholders when they purchased the equity shares at the time the shares were originally issued. Common stock is the most common form of contributed capital, representing the basic rights of ownership, the right to control management, and the right to profits. Both rights are in proportion to the percentage of ownership. Retained earnings represents a measure of the funds provided to the company from all the company's past profits, that is, past revenues minus past expenses, less all the past dividends paid to the shareholders. In other words, retained earnings represents a measure of the past profits not withdrawn by the shareholders. That is, earnings from prior periods retained in the business, thus the name retained earnings. Summarizing shareholders' equity, it represents the investment made by the shareholders in the company, either by purchasing the company's shares when they were issued, contributed capital, or allowing profits to remain in the business, retained earnings. It is important to understand that the four financial statements all come from the basic accounting equation. For example, the balance sheet is simply a statement of the basic accounting equation at a specific point in time. The total dollar value of the assets listed on the balance sheet equals the total dollar amounts in the liability and the shareholders' equity accounts. Further, all past income statements, revenues minus expenses, are contained within the retained earnings account. Recall that retained earnings contains all the net incomes, revenues minus expenses, of the past minus all past dividends paid to the owners. The statement of shareholders' equity is simply a description of the activity in the shareholders' equity account from one period to the next. It describes what happened to the company's contributed capital and its retained earnings. And finally, the statement of cash flows is simply a description of the activity in the cash account from one period to the next, broken down into three categories: net operating cash flows, net investing cash flows, and net financing cash flows. In other words, the balance sheet, a statement of the basic accounting equation, houses all three of the other financial statements: the income statement, the statement of shareholders' equity, and the statement of cash flows. In the next video, we rely on an understanding of the relationship between the basic accounting equation and the four financial statements as we learn how to use the accounting equation to prepare the financial statements.